All right, so here we go, cost volume profit analysis. The point is, and probably some of you have picked up on this already, is that there's a relationship between your costs, the volume of your sales, and your profits, okay? And that relationship has a lot to do with the difference between your volume of your sales and your sales amount and your costs, right? That's what leads to profit. So I don't think there's anything that's rocket science here, but I do like that they look at it a little bit differently. So there's the learning objectives. I won't read them. We'll just get into it. So determine how changes in volume affect costs. Okay. Well, this would be super easy if all costs behaved the same way, but they don't. At this stage, and hopefully even in the first semester, you start to recognize that not all costs are the same. Some costs are variable in their nature, meaning the higher your sales volume, the higher your cost. The perfect example of this is cost of goods sold, right? If every item I sell costs $1, then the more items I sell, the higher my cost of goods sold. Other costs are fixed, meaning regardless of my sales, I still have some fixed costs. A good example of that would be rent. I have to pay $500 in rent on my building. And whether I sell 1 unit or 1,000,000 units, I still pay that same $500. So it's fixed. The third type is called a mixed cost. Some costs have a variable component and a fixed component. A good example of that might be our utilities. Just to have our utilities on and running, regardless of our volume, there's probably some cost involved with that. But if we have a whole bunch of customers coming in and out and opening the door all day, we may have to pay more to keep the building cooled off and things like that. So there may be some mixed relationship, some fixed component plus some variable component. Okay? So this is like, in my mind, this is an incredibly important concept when we're trying to understand how we make money and how we don't make money in business. All right, so this is kind of what I just explained. Variable costs remain constant per unit. What I mean by that is if I've got a variable cost of $55 per tablet and I sell 0 tablets, then my total variable cost is $0. If I sell 25, it's going to be 25 times 55. Right? If I sell 100, it's going to be 100 times 55. The per unit cost stays the same all the time. That's the nature of variable costs. They stay constant on a per unit basis. Okay? So if I were to graph that as a line, it would be a straight positive correlation type of line. Right? The more units I sell, or in this case produce, oh, sorry, this is something totally different. I thought they were using that table. Here they have the cost of batteries per units produced. But the same idea, right? Variable units are always going to look like that. They're going to be a straight line with a positive relationship. The more I sell or the more I produce, the more the cost. Fixed costs, on the other hand, are always going to be a flat line, right? Regardless of the number I produce or sell, my fixed cost stays the same. It's fixed, which means that our fixed costs are not constant on a per unit basis. They're constant on an overall or a total basis. And actually, the more units I can sell or produce, the lower my fixed cost per unit. So here's an example. They have $12,000 in fixed costs. If they produce 25, then their fixed cost per unit is $480. If they produce 100, then their fixed cost drops to $120. Right? Because the cost is the same no matter what. So the more units you make, the lower your cost per unit. All right. So there's their characteristics. This is straight out of the book. And they have it total cost and cost per unit. The total cost changes proportionately to changes in volume. with variable costs and remains constant with fixed costs. And on a per unit basis, variable costs remain constant per unit, and fixed costs change inversely to changes in volume. The more you sell, the lower your cost per unit. Yeah. All right. So mixed costs, like I said, have both a fixed and a variable component. Here's what a graph's going to look like. Instead of it starting where variable cost did, where it started down at 0, right? Because if you sell or produce 0 units, then your variable cost is $0, and so it goes up from there. Mixed costs start at some fixed cost point, right? Regardless of the number we sell, it costs, in this case, $100, and then it goes up in a positive straight line way after that. Does that make sense? So the only difference between the mixed costs and the variable costs is the slope, the variable cost and the intercept. The variable cost would come down here and intercept at 0 and have a certain slope, and the mixed cost is going to intercept at the fixed price or the fixed cost and then go up from there.
Is there graphs that start like it starts inclining at 200?
Sure. Yeah, whatever that fixed cost point is. So on a mixed cost, it has a fixed point plus a variable point. So whatever that fixed is becomes the x-intercept. I'm sorry, the y-intercept. Crap, we have to go back to algebra. Y equals mx plus b. Yeah, a little bit. All right. No one ever told me this math would be used for real stuff. All right. It's true, it's barely. And except the other day, I'm building a wall at my house, and I was like, how do I make sure that I get a good angle when I'm building a room? And I call my father-in-law, dumb old carpenter, over. He's like, 3, 4, 5 triangle? I'm like, what? He's like, a 3, 4, 5 triangle. It's always the right angle. Like, everybody knows that, you know. So I was like, okay. So if I measure one side 6 feet and another side, and then another side 8 feet, and make a mark on a angle, like an arc, and then I measure a hypotenuse of 10 feet from the 6-foot mark and make an angle to where it intersects the 8-foot mark. That mark is a perfect 45 degree. It's just trigonometry. You learn that in trig, but you forget. I could use sine, cosine, and tangent too, but I don't think that would have helped me in that situation. Yeah. All right. So if we're going to try to figure out what portion of our mixed costs are fixed and what portion of them are variable, then we can use a method called the high-low method. It's pretty easy. You probably learned something like it in high school algebra or maybe 8th grade. And most of my kids take algebra in 8th grade now, right? But here's what we do. So if we plot out our total cost and our total volume, then we pick out the highest volume and the lowest volume. This is how we figure out when we have a cost we suspect is mixed in nature, what part of it is fixed and what part of it is variable. Okay? So we plot out our information, we take our highest and lowest volume, and then they give you 3 steps. So identify the highest and lowest levels of activity, and then that we can use that to calculate the variable cost per unit. So the variable cost per unit equals the change in total cost divided by the change in volume of activity. So we take our highest cost minus our lowest cost, that's the change in cost, divided by our highest volume and our lowest volume, that's the change in volume, and that gives us a variable cost, in this case $2 per unit. Okay? Once we know our variable cost, we can find our fixed cost, which is the total fixed cost equals the total mixed cost minus the variable cost. So our total mixed cost, we took that as our high point. Theoretically, you could use your low point too. You could use either one of them, but I always just use the high to be consistent. So we take, and then we take our variable cost per unit times the number of units. What's important when you do this is if we're going to use the high cost, the 1960, let me go back. So remember, our high was 1960 and our low was 1480. So if we're going to use our high cost, then we have to use the volume at the high cost. If we use our low cost, you have to use the volume. You have to be consistent with what you're doing, okay? So here they use the high cost for the total mixed cost minus the variable cost times the volume at that same level. And that comes up with the fixed cost. If you think about this, those of you who remember algebra, this is just y equals mx plus b. It's just recast, okay? It's just, that's the equation for a straight line to figure out the slope and the intercept, okay? So once we've used the variable cost per unit and the fixed cost per unit, we can determine the total mixed cost at various levels of productivity, right? Because now we know that our total mixed cost is $2 variable plus a total fixed cost of $1,000 once we've calculated that out. I promise it's not very hard once you get into it. It seems a little bit like when I'm just trying to show it to you on a slide, but you'll do it and you'll be like, okay, this is compared to some of the stuff we've asked you to do, this would be easy. And then there's one last concept. Sometimes, especially when we're working in production, there's what's called a relevant range, and this is something you'll learn about like in statistics. The idea is you can't always assume that same straight line relationship to exist at all volume levels. In fact, you hope it doesn't. You hope that if you produce a higher volume, you can lower some of those costs, okay? So this won't really come up in the homework. You just have to recognize that you can't always assume something to be true. You still need to test it as your volume grows and say, are the same cost behaviors occurring here, or could they be different, okay? All right, so let's move on to the next one. Operating income using contribution margin and contribution margin ratio. So what we've always done is we've used a traditional income statement that does product costs or period costs, right? Or in other words, we talk about cost of goods sold versus costs of the period, or costs that are being charged to this time frame, okay? Remember, product costs are those costs that are pushed forward and won't be claimed as costs until we actually sell the product, as opposed to all the other costs, which are costs we're going to claim as costs right now during the period. But now we're going to shift, and pretty much for the rest of the course, we'll start thinking in terms of what's called a contribution margin income statement. These are never used in financial accounting, but they're almost always used in managerial accounting, where we classify our costs by behavior, variable cost versus fixed costs, okay? So the difference between the net sales revenue and the variable cost is what we call our contribution margin. So remember the income statement you've always done in the past, which is revenue minus cost of goods sold gives you gross profit, minus expenses gives you minus operating expenses gives you operating income, minus any non-operating expenses gives you net income. That'd be the more complex one. Now we're going to do contribution margin, which is variable cost, net sales revenue minus variable costs gives us contribution margin, minus fixed costs gives us net income. The reason we do this is because the way we control variable costs is different than the way we control fixed costs. Stop and think about it logically. The way how do I control a variable cost like product cost? What can I do to control that and keep it lower? What's that? Yeah, I could sell less stuff and that would reduce the cost of goods sold, true, but that's probably not the best option. You know, if you think about it, it requires a fair amount of work to deal with variable costs. You've got to try to negotiate with a supplier for a cheaper cost on so that your raw materials are cheaper, or you've got to really streamline your production processes. Okay, as opposed to fixed costs, things like utilities and rent, which usually involve some sort of renegotiation or keeping the lights turned off. They're very different in the way you deal with them, and so if we look at things by the type of cost, it makes it easier for us to start to solve those cost problems and reduce costs, okay? All right. So contribution margin can be expressed as a unit amount. So net sales per unit minus variable cost per unit gives us a contribution margin per unit. Okay. It can also be expressed as a ratio, where we take our contribution margin divided by our net sales revenue gives us a percentage. That's called the contribution margin ratio. So that's the three ways, I guess, that you can express it. You can do contribution margin just as a total amount, as a per unit amount, and as a ratio. And if you were to do the division problem to find the ratio with the total amounts, 45%, or with the per unit amount, 45%, it would come out to the same contribution margin ratio either way, whether you were dividing the per unit cost or the per unit contribution margin divided by the per unit sales revenue or the total. Okay, so that relationship always exists there. So a contribution margin income statement, like I said, it looks like this. Net sales revenue minus variable costs equals contribution margin minus fixed costs equals operating income or net income profit. Okay. All right. So that's, I think I just casually introduced a concept that is going to carry through the rest of the course. Just recognize the idea of a contribution margin income statement is used exclusively for managerial work, not in the tax or financial side, because it's really valuable for understanding relationships between costs, but doesn't follow generally accepted accounting principles that are required for tax reporting and for public disclosures for publicly traded companies. All right, cost volume profit analysis. All right, so we do all this because we're interested in cost behavior. In other words, we're interested in understanding how costs accumulate in our business and how we can control costs. Okay, making more sales is harder than it sounds. And the only way to increase our profits is to make more sales or to reduce our costs. That's it. So this is one of the big two, so to speak, that can decide whether or not you stay operating or you go under. So CVP analysis is simply a planning tool that helps us look at the relationships and helps us make decisions based on those relationships. That's all. Often we use it for what's called target profit analysis or what's called break-even analysis. And so the way this textbook does it, and I like the way they do it, is they break it into three different approaches to cost volume profit analysis. The first they call the equation approach, the second the contribution margin approach, and the third the ratio or contribution CM ratio approach. So here's the equation approach. We know that our net sales revenue minus our total costs equals our operating income. We learned that a long time ago, right? Revenue minus costs equals profit. Piece of cake. We also know that we could restate this as net sales revenue minus variable costs minus fixed costs equals operating income. Or in other words, our total costs are our variable costs and our fixed costs together. So if Smart Touch Learning desires a target profit of $6,000 using the equation approach, it finds it needs to sell blank units. Okay? So all we do is we say, we have one more leap to make here. Our net sales revenue is the same as our sales price per unit times the number of units sold, which makes sense, right? My price per unit times the number I sell is my total revenue. My variable costs are my cost per unit times the unit sold. My fixed costs are some fixed amount. Okay? So if I need to figure out, if I'm shooting for a target profit of $6,000 and I want to know how many units I have to sell, I can pretty much just use this equation and leave units sold as the unknown variable. Right? So now I've got well, you can follow the math. I don't need to explain it to you. In the end, I end up with units sold equals 18,000 divided by 225 per unit, or 80 total units. Okay. Most of us don't use the equation approach because it's kind of bulky and unwieldy. We can jump just straight to the contribution margin approach, which really is the exact same thing as the equation approach, just with all the crap cut out of it. Okay? So now we just say our required sales in units equals our fixed costs plus the target profit divided by the contribution margin per unit. See what I mean? That's exactly where we ended up here down at the end. But we just jumped straight to that. So required sales in units is fixed costs plus target profit divided by contribution margin per unit. So that's it. There's your formula for that. The third is the contribution margin ratio approach. Remember, we figured out our ratio earlier. $225 per tablet divided by $500 per tablet. That's our contribution margin divided by our net sales revenue. Gives us 45%. And that can help us calculate our required sales in dollars. Fixed cost plus target profit divided by the contribution margin ratio. That's it. So that's the 3 ways to go about this CVP. It's not hard math, but it's easy to forget, like, which way? In real life, what you do is you find the one you like and you use that one all the time. In a class setting, they're trying to say, look, these are 3 different approaches. Different people use these different approaches. Okay? This is one of the things I like about managerial accounting. You can do it the way that works for you instead of, anybody have the math teacher that requires you to do it their way, regardless of whether or not their way is the best way? And if you try to say, your way is not the best way, they'll go, what do you know about it? I've been doing this for 30 years, you punk kid, like that. I don't think they would say it like that. They might. All right. So sometimes rather than finding a target profit, like, hey, I'm shooting to make $6,000 in profit, what we want to find out is what's called the break-even point. Break-even point is the point at which my contribution margin equals my fixed expenses. Remember, contribution margin is my revenue minus my variable expenses. So at the point where that amount equals my fixed expenses, I've broken even. I have 0 profit and I have 0 loss. Okay? So you can use the same 3 approaches before, but instead of setting some target profit like we did on the last one, your target profit equals 0. That would be the break-even point when you make a profit of 0. Does that make sense? So there's a bunch of stuff really little that just shows them using all 3 approaches that we just used to solve for a target profit of 0. So in this case, it came out to 54 units. Here it's interesting because they use the contribution margin ratio to solve for the volume or the sales in dollars, which I don't think you really need to do. You just look at your fixed costs and you would know that times the exactly that divided by the contribution margin ratio gives you that amount. All right. Here's a graph. I wish it was a little brighter. I don't know if I can close this. Oh, that just closed that little tiny one. Because some people are graphically minded, and if you can see this graph a little better, it would help you understand the relationship a little better. All right. So here what they've done is they've graphed a couple things. Number one, they graphed the sales revenue. So sales revenue, if you think about it, is a variable sort of relationship. If you sell 0 products, you make 0 revenue. If you sell 1 product, you make whatever it is. I think it was 500 a unit. And so it just goes up in a straight line. That's the blue line, sales revenue. Second, they graphed their fixed costs. They were $12,000. Regardless of the number of units, that fixed cost is always $12,000. Third, they graphed their total costs, which is the fixed cost plus the variable cost. So you'll notice it starts at the fixed cost, and then it goes up in that way. You'll notice where our total costs intersect our sales revenue, we have a break-even point. Makes sense, right? When you sell enough to cover your costs, that's break-even. You have 0 profit. All of this represents an operating loss, the point at which our revenue has not yet reached our total costs. All of this represents an operating income. The thinner your margins, the narrower this is. Okay? The fatter your margins, the wider that is. So we can look at it graphically. Again, this is just basic straight line math algebra. Okay? All right. So we can also do what's called sensitivity analysis, which is really just saying what if, when they say sensitivity, they mean how does this, how would a change in fixed costs affect our profits, or how would a change in variable costs affect our profits, or how would a change in selling price, or whatever, okay? So that's what we're talking about with sensitivity analysis. So there'll be questions like this. If the sales price changes from 500 to 475, the number of units needed to break even would do what? So it's not that hard really, because all you do, we're looking for break even, so we have our fixed costs plus our target profit, which is 0 on the break even. And then we change this from 500 per unit down to 475 minus our our variable cost, and rerun it. Okay. So all they mean by sensitivity analysis is this question of, well, what if we did this? What if we changed the sales price? What if we changed the? As you can imagine, anybody who works in this a lot has pre-made calculators in Excel or through some web-based tool, so that they can kind of run a whole range of them and say, okay, I'm going to do sales price anywhere between $250 and $300 in $5 increments, do a sensitivity analysis. And it'll give you an output of profitability and everything else at each sales point level. If you do it all the time, you come up with tools. All right. Same idea, if our variable cost changes, again, we just use the same things we already used, the same formula, and plug in the new variable costs. So nothing hard there, right? Same in change in fixed costs. And here's just sort of an overall effects that we would expect, but we don't need to spend any time on that. All right. Then we use CVP analysis to calculate the margin of safety, operating leverage, and multi-product break-even points. So now they're taking the same concepts and making them a little more challenging, I guess. All right, so these are the three things we use this for. So margin of safety is just the excess of expected sales over break-in sales. So if we say, hey, we expect to sell 600 units, or listen, in this case, they're going to say they expect to sell 100 tablets, and they know that they need 54 to break even, then they would say that their margin of safety is 46 tablets. Does that make sense? It's just the number over and above what you need to break even. That's it. That's all margin of safety is. We could also figure out our margin of safety in dollars, which is our margin of safety in units, times our sales price per unit, which is $23,000. In this case, we would know that we have a pretty good margin of safety, that our sales would have to be way off in order for us to not break even. That's a good place to be and to know where you're going to be. Finally, we can do our margin of safety ratio, which is our margin of safety in units divided by our expected sales in units. So it's 46%. So that's margin of safety. Next, we have operating leverage. And operating leverage has to do with how our fixed costs will impact our overall operating income. And then this is the important part. The degree of operating leverage can be measured by dividing the contribution margin by the operating income. That's called your degree of operating leverage. So contribution margin divided by operating income. Company A has a 2.5. Company B has a 1.25. What that means is percentage change in operating income will be 2.5 times the percentage change in sales. So what you want to have is a higher degree of leverage. Okay? What that means is the more company A's sales go up, like if their sales went up at equal rates, more of it would be converted to operating income for company A than for company B. Actually at double the rate. Okay? That's what that means, operating leverage. Higher is better, and we find it by taking our contribution margin, which if you remember that, it's our revenue minus our variable expenses, divided by our operating income. In other words, how well are we converting or changing that contribution margin into net income or profit. That's really what we're saying. All right, sales mix. So life would be easy if all companies only sold one product. The math would be super simple, right? But in real life, there's lots of variability to that. We call that our sales mix or product mix. So here, you'll see that they just have to deal with multiple contribution margins. You'll notice that the scratching post contributes a much higher amount of the contribution margin than the cat beds do. This happens all the time in real life. I've explained the scenario several times already, the idea where you have multiple products and some are barely making money and the other ones are making lots of money, right? And so you either decide to eliminate the one that's barely making any, or sometimes they say, that's the product I love to make, so I'll suck it up and barely make anything on that, but I'll sell these others to sort of support my artistry of getting to make these lower margin products. There's nothing here different than any of the other stuff we've already covered, other than we're dealing with more than one product, and so each product has a different unit contribution margin. That's all. We can do a weighted average of the contribution margin, which is just our total contribution margin divided by our total units. But I haven't found that to be very useful to me. I have to kind of look at each product as it is and understand it as part of my mix. Anyway, so that's it as far as the textbook stuff. Now let me show you a little bit about this problem here, or these sample problems. Let me pause this.